Imagine a world where the quiet confidence in government debt begins to fracture overnight, where an unexpected spark ignites a rapid shift in investor sentiment, and where the metals that have endured for millennia suddenly become the bridge to whatever comes next. As the second half of 2026 unfolds, that possibility no longer feels distant. The financial system that once rewarded endless borrowing, unchecked money creation, and the belief that certain assets could rise without limit, now faces growing questions about sustainability. The central issue is no longer which sector might climb higher in the near term. It is how capital can be positioned to endure and potentially advance through a phase that appears increasingly unforgiving. Observations from recent travels through major Chinese cities reveal an economy operating under visible strain, yet still displaying pockets of technological ambition. Luxurious shopping malls that once replaced crowded street markets now stand largely empty inside their retail spaces. Corridors fill with people seeking refuge from the heat, using the air-conditioned halls as informal gathering spots for conversation, card games, and children's play areas. Yet the shops themselves, some spanning thousands of square meters and stocked with high-end domestic brands, often contain only a solitary attendant waiting for customers who rarely appear. This emptiness signals caution among households. Spare spending power feels limited. Concerns about employment security linger. At the same time, the population appears generally well-dressed, and modern electric vehicles, many resembling advanced models familiar in Western markets, populate the roads and display areas at prices far below those seen in Europe. Automation and artificial intelligence surface in everyday settings. Certain restaurants already rely on robotic servers. Diners frequently order through QR codes, and delivery by machine occurs in selected locations. Discussions among locals even touch on emerging humanoid robots sophisticated enough to raise official questions about social implications, including potential effects on marriage and family formation. Domestic artificial intelligence systems dominate daily use because external platforms remain restricted, forcing reliance on locally developed alternatives. These details paint a picture of an economy that has slowed in consumer activity while accelerating in technological adoption, a combination that carries implications for global demand patterns and resource consumption. Against this backdrop, the role of precious metals continues to evolve in the minds of those focused on longer-term preservation. For years, the dominant narrative framed gold primarily as a hedge against rising consumer prices. That framing has broadened. Increasing numbers of observers now view the metal as a potential vehicle for crossing into a restructured financial environment. At some stage, an unforeseen incident or accumulation of pressures could force a restart of the existing system. In such a scenario, holders of substantial government obligations and cash balances, particularly those outside the issuing country, risk significant impairment, whether through accelerated inflation, capital controls, or the introduction of central bank digital currencies that restrict conversion of legacy holdings. The outcome could leave traditional paper assets diminished. Tangible assets that can be held, verified, and transferred without reliance on the prevailing monetary architecture gain appeal in that context. property and productive equity would remain. Yet gold joins that category of items expected to persist across the transition. The current environment of elevated government indebtedness across major economies has not reversed this logic. In fact, the direction of policy and fiscal outcomes over the past year has reinforced rather than weakened the underlying case. Sentiment, rather than any precise numerical threshold, determines the tipping point. Debt-to-output ratios can climb for extended periods without immediate crisis, as demonstrated by economies that have operated well above conventional limits for decades. No magic percentage triggers automatic collapse. What matters is the moment when confidence erodes. Sentiment can reverse far more abruptly and dramatically than the underlying statistics. A poorly received fiscal announcement, an unexpected geopolitical development, or simply a shift in the language used by key institutions can initiate the process. Once underway, the move away from government debt can accelerate within months. Historical episodes illustrate the speed. Several years ago, a change in budget proposals in a major European economy triggered rapid selling of its long-term bonds. Pension funds that had employed complex leverage strategies found themselves forced to liquidate, amplifying the decline until official intervention restored order. Similar contingency planning almost certainly exists within every major treasury and central bank. The open questions concern the speed of implementation and the effectiveness of the chosen tools once markets begin to test the limits. One measure that remains available yet unused involves the official valuation of existing gold reserves. Revaluing those holdings at a substantially higher price would generate accounting gains that expand available resources without additional market borrowing. Precedents exist from earlier decades when governments adjusted official prices and rearranged ownership between treasuries and central banks, producing immediate liquidity while leaving the metal itself under public control through non-interest-bearing, non-redeemable instruments. Executing a comparable transaction today through legislative authorization could reduce the need for new debt issuance, create scarcity in the existing bond market, and lower yields. Once rates had declined, re-entry into the borrowing market would occur on more favorable terms. Such a step would likely be reserved for a moment of genuine pressure rather than implemented in calm conditions. Its mere availability underscores the range of options still open to authorities facing rising interest burdens. In the largest economy, the annual deficit remains elevated, with interest costs consuming a substantial share of that shortfall. Rolling over maturing obligations while covering new spending requires continuous access to willing lenders. Should those lenders demand progressively higher compensation, the pressure on official balance sheets intensifies. The relationship between expanding money and credit aggregates on one side and measured consumer prices on the other has also shifted. Earlier definitions treated inflation primarily as an expansion of the circulating medium, with rising prices as a symptom. In a modern economy, where many consumer items can be supplied in near unlimited quantities, additional purchasing power does not automatically translate into higher prices for everyday goods. Instead, the surplus flows toward assets perceived as scarce and desirable. Equities, property, fine art, and the precious metals. Government debt itself functions increasingly as a near-money instrument, liquid and widely accepted. Combining the growth in traditional money measures with the expansion of public debt produces a broader gauge of monetary expansion that far exceeds official consumer price indices. That broader expansion continues, supporting the longer-term case for assets that cannot be created at will. Silver occupies a distinctive position within this landscape. Industrial demand from electronics and remaining photovoltaic applications continues to exceed primary mine output according to industry assessments. Above-ground inventories available for delivery have declined meaningfully over multi-year periods, even if shorter intervals show temporary stabilization. Each ounce carries an implicit reservation price in the mind of its holder. Drawing additional supply into the market therefore requires either a change in that reservation price through shifting sentiment or a rise in the market price sufficient to meet it. While substantial stocks remain, the quantity is finite, and the willingness to part with them at prevailing levels appears diminished. Bull markets in commodities rarely advance in straight lines. Periods of consolidation or sharp pullbacks interrupt the trend, yet the fundamental imbalance between ongoing industrial absorption and constrained primary supply has not disappeared. Personal experience with these markets stretches across multiple cycles. Exposure to high inflation in earlier decades, when annual rates briefly reached extreme double-digit levels, reinforced the pool of holdings that required no counterparty performance. Early acquisitions of gold coins and silver coinage accumulated over time without subsequent liquidation, reflecting a philosophy that such assets serve as multi-generational insurance rather than short-term trading vehicles. The same principle applies today. Physical ownership provides a form of optionality against scenarios in which electronic systems or paper claims encounter disruption. Educational efforts aimed at younger audiences attempt to convey these concepts in accessible form. Illustrated stories simplify ideas such as the consequences of excessive credit creation, the role of savings, and the distinction between productive and non-productive uses of capital. By presenting complex mechanisms through narrative and imagery suitable for children, the material aims to build foundational understanding that can later support more sophisticated decision-making. Availability without cost or registration removes barriers, allowing families to introduce the topics at their own pace. Across decades of observing capital allocation, one recurring error stands out above others. Concentrating an excessive portion of resources in a single favored position creates two opposing psychological traps. When the position advances, the temptation arises to realize gains prematurely, exiting before the full potential has been expressed. When the position declines, the reluctance to accept a realized loss encourages holding far beyond rational recovery expectations, often waiting for an improbable return to the original purchase level. The practical countermeasure involves beginning with a deliberately modest weighting, small enough that daily price movements do not dominate attention. Only after living with the exposure and assessing its behavior relative to the broader portfolio does gradual adjustment become appropriate. The moment an individual finds themselves monitoring a holding with constant intensity usually indicates that the size has already grown